had an hour this morning on the economic outlook. Now, what does it mean for the fund's asset allocation? This is where the rubber hits the road. Asset allocation accounts for probably 90% of a fund's absolute returns and at least half of a fund's relative returns against its competitors or other funds they compare themselves to. Getting this right is probably the most important decision the funds make in terms of building their investment portfolios.
In terms of what's happened with credit markets generally, my personal view is I think the fact that it's happened now is probably a good thing rather than a bad thing. I think if this financial bubble had have gone on for much longer, I think that very much would have been to the detriment of long-term returns. It would have been great for short-term returns, but I think long-term equity returns would have been severely impacted if this had have gone on. It's a bit of a wake-up call. To start with, I just want to, to give you a picture of where, the Australian market sits in an overall context of this cycle. I think one of the key differences about where we sit today is if you go back and look at the last, bust that we had, came out of the back end of the TMT bubble. Australia actually sailed through that pretty well. And that's simply because Australia is not a technology-rich market. A lot of the excesses that were occurring in global markets just didn't happen in Australia, and the level of overvaluation in the Aussie market didn't occur either. The nature of this boom, if you like, the epicentre of it is clearly coming out of China, but then there's also the financial leverage aspect and the packaging aspect that has been driving markets globally as well. Now, if you look at the structure of our market, materials represents more than 20% of the market, so that's your direct exposure to China. The financial sector, and that's excluding insurance, is probably 20 to 25%. That's banks, and I'd also argue property, which is another 10% plus of our market. And then if you look within a couple of these, these mega investment banks, what I call the House of M's, which is the House of Macquarie, probably actually represents about 10% of our market. And the House of B, which is Babcock and Brown, probably represents another couple of percent as well. A lot of these factors that have been driving markets this cycle, Australia is actually the epicentre of what's been going on. So this cycle is very, very relevant to the direction of the Australian equity market. I just want to touch on the consumer here. Consumer here, the same as the US, has taken on a lot of debt this cycle, so gearing levels are a lot higher. I think the key difference here is that wealth in Australia now is actually far surpasses that of the US. So that gives us some sort of cushion. However, I would say a lot of this is actually autocorrelated, so a fall in the equity market and the fall in the domestic property market would actually reverse these quite a lot. The other thing is the excesses, certainly the subprime type excesses, just haven't really been happening here in Australia. So the mortgage market here is much more controlled by the big banks. Even the non-bank lenders are much more rigorous in terms of their own credit assessment. But there has been, leveraging going on through not just leveraging into equity markets. So we've seen margin lending go through the roof, CFDs, warrants, whatever you want to call it. These types of instruments have absolutely exploded. If we look at the other side of the equation, so you look at default rates, no different here. Default rates here are as low as they've ever been, and I think you've seen almost a generation of investors in the Australian market that have never really seen a downside to the market and really don't know what a correction is. So there is risk there. What's different about this cycle versus last cycle in the late 90s is I think the key thing is the markets in terms of PE ratios have really been pretty stable through this whole boom. So this boom has been all about earnings. So if there are risks in markets at the moment, it's about the E in the sustainability of earnings in asset allocation models. And I've got a couple of slides later which will highlight sort of where we sit in the cycle. And I guess the other issue here that most would be aware of is that we've had convergence of price-earnings ratios between Australia and world markets as well. So as we sit here today, the Australian PE is about on par, probably a bit above world markets. There's also been, I believe, a very good reason for why we've converged, and I think one of the key reasons is just simply that the returns that the average Australian company generates is actually superior to a lot of their global counterparts. So even versus the US, for example, the average return on equity for an Australian company now sits at about 18-19%, whereas for the US companies, you're probably looking at about 16-17%. Now that's a good thing in one sense. I guess the bear case is, and this is the key question about the E, is how sustainable is that return on equity, and not just in an absolute sense but also a relative sense. Now the other symptom, as I said, this cycle has very much been driven by earnings, and you can see that illustrated pretty graphically on this slide here. This goes back to the early 70s. Now earnings generally in an equity market sense will grow roughly in line with nominal GDP, so that's about 6-7%. And that certainly has been what's occurred over the last 20, 30 years. Now this cycle, earnings in Australia have generally grown at about 20-25% per annum. So clearly well above trend. Now I think a lot would say, oh yes, that's the China boom, and that's certainly been the case. You see resource earnings have grown at about 50% per annum during this period. But even if you exclude resource earnings, industrial earnings have grown at about 18% per annum. So that's 3 times GDP. So if you go and drill down on a sector-by-sector basis in the Aussie equity market, there's very few sectors that aren't trading on peak of cycle earnings. I mean, you can probably count 1 or 2 sectors maybe that aren't trading on some sort of cyclical high. So we do have an issue here as to how long is this fat tail of earnings going to last, particularly in places like the resource sector. We have had long-term underinvestment in a lot of these commodities. So 10 to 15 years of underinvestment is not going to be fixed overnight. And certainly if you speak to any of the resource companies, it's still very much pedal to the metal. The investment phase is going to last anywhere between 3 to 5 years. A wobble in the US, I don't think is going to stop any of these resource companies from investing. The outlook for China still remains very strong. A lot of these are very capacity constrained, so I don't see anything in terms of risk there. I think the key risks probably range around, we've been through what's been pretty much a sweet spot for equities, and that has, I think, been a number of things, certainly the synchronisation of the global cycle, but also collapsing of credit spreads and risk premia generally have seen equities generate returns which are pretty much as good as it gets. I think the other thing in Australia specifically is we've been through a very strong period of industry consolidation and restructuring, the benefits of which I think will be quite long-lasting. And I think the other key thing about companies this cycle is that capital management has generally been very good. So companies have generally been very shareholder friendly. If I want to put up a scary chart, this is probably the scariest chart I'll put up. If you look at long-term trend earnings, so you look at that 6 to 7% trend, and then you look at where earnings currently sit versus that trend, you can see here we're sitting at about somewhere between 60 and 70% above that long-term trend. It has happened before, and that was back in 1989. Now, I think there's a lot of similarities between, there's actually a lot of similarities and a lot of dissimilarities between the late 80s and the current environment. I mean, the obvious one is a commodities boom. So that was our last commodities boom, and that drove earnings much higher here. It was also a property boom as well, so here we are in the midst of a property boom. But I also think there's a lot of differences as well. So, for example, I think the key one is leverage within corporate Australia. If you go back to the late 80s, the average debt-equity ratio of an Australian company was probably somewhere around 100%, and interest rates were about 17%. As we sit here today, debt equity is probably around 40-50%, and of course interest rates are more like 6 or 7%. I think the other thing too is that governance generally in Australian companies is much stronger. Certainly back in the late 80s it was nothing short of appalling, I think. So where to from here? I think in terms of asset allocation models, it is really about what are the earnings prospects, because to be honest, with earnings being at such an elevated level, you can plug in any earnings number you like into an asset allocation model, you get the answer you first thought of, depending on whether you're bullish or bearish. But personally, I just can't see that returns this high are sustainable. They're going to have to come down for some reason, whether that be the US recession. And I'm very much in agreement with both Chris and Alison that the key risk is a US recession, and particularly I think it's also its transmission effect into China, if any. I think that would be the Armageddon scenario for equities, is if the US recession did actually slow China, because once again we're at the right of the front and centre of that. I've talked a bit about China, but I think it's pretty obvious that our terms of trade, and this is also not just the direct effect on the resource sector, but also the flow-on impact into things like discretionary expenditure and whatnot, has been very much driven by the improvement in our terms of trade.
At the very broadest level, as investment professionals, we're really charged with the responsibility of maximising risk-adjusted returns and ensuring that those returns are relatively consistent regardless of the environment that we're in. So we've all been talking about US recession, not US recession, the implications of China, whether it can decouple. But at the end of the day, I think you want to start with the following premise. The biggest mistake you can make in investing is the top chart. Basically, as you build wealth, what happens to your risk appetite? The wealthier you get, the more aggressive you're prepared to be in your bets, and you actually increase the size of your positions. Typically, that's the emotional response. On the other hand, if you're losing wealth, equity markets are collapsing, credit spreads are blowing out, the world seems to be going to hell in a handbasket, your natural reaction is to reduce the risk in your portfolio. Actually, I think the better way to think about managing money from an asset allocation perspective is summarised better by the curve on the second panel of this chart, which suggests that as you get to the top end of reasonable estimates of valuation, markets look expensive, the kind of things Peter was talking about, that the potential for further PE expansion is less likely, that you're pulling back towards a fundamental environment where earnings and the direction of interest rates will tell you where the price of equity markets go, mean that you want to start taking some risk off the table. On the other side, where markets have collapsed, and there is clear valuation opportunity, you want to start tentatively building positions. In March 2003, valuation, whichever way you measured it in equity markets, looked very cheap. That was the point, back in March 2003, from an asset allocation perspective, basically to buy equities with your ears pinned back. You wanted a growthy portfolio. All the way through until recently, equity markets have been catching up with fundamentals, and one of the characteristics, most notably here in Australia, has been the fact that unusually through this cycle in equity markets, analysts have tended to be revising up their forecasts of earnings to keep up with the fundamentals, not the other way around. Right now, equity markets, whichever way you measure them, seem to be at least not cheap, and certainly towards the top end of any fair value measure. We're coming back to fundamentals. It's not about PE expansion. So the better part of Valor tells you that you're better off preserving capital, managing the risk, whatever happens, whether you get a recession or don't get a recession. If you're responsible for managing money, you take some risk off the table and move to a more balanced portfolio. And then what you have to think about is where are the risks outside of equity markets, because fixed income turned out to be not as defensive as some people thought. People exposed through fixed income into the credit markets lost money, as you have seen people lose money in equity markets recently. So understanding where the environmental risks in your portfolio are is very important, I think. So equity markets back to fundamentals. This is splitting the Australian market into resources and industrials because they are quite different components. The resources part of our market is all about leverage and vertical integration into the China, Asia, India story. Industrials are less so. Both markets, as I said, are still at the top end of fair value ranges, and what determines their trajectory from here will be the economic fundamentals, will be what happens in the United States, etc. Decoupling is the term we've used already in the economic discussion, decoupling of China from the United States in an economic sense. Well, that's all very interesting and subject to lots of opinion. But what has been obvious in the last month or so has been the decoupling in financial market behaviour, that actually the developed equity markets have underperformed while your developing regions have continued to perform. Part of the reason for that is an acknowledgement that the emerging markets, the developing markets, are capital exporters, not importers. So an environment where capital is being repriced is something that can weather better. Another point is that their economies have actually improved. Their corporate governance model is on the way to improving. So these markets have been behaving or decoupling from developments in the developed world. And for investment professionals, that's worth noting. And then there's the currency. Chris took you through the view of the currency, and all I wanted to do here was put two scenarios to you just to illustrate the difficulty with managing currency and your hedging positions in an asset allocation perspective. What you see here is a fair value model of the currency, and these are a dime a dozen as well, but this one has commodity prices and interest differentials, the two things that most people accept drive currency markets as well as inflation differentials, you see on the left-hand side a picture of global industrial production. So let's assume the soft landing. The US slows to around 2%. Japan and Europe also slow a little on the back of that, but remain at or above trend. China slows a little, but not too dramatically. We're still growing at 8 or 9% in 12 months' time. And so the forecast from a top-down perspective for commodity prices certainly sees commodity price inflation slow, but commodity prices remain constructive, positive. In that environment, the Australian dollar at current levels is actually undervalued. So this is a good opportunity, if you're completely unhedged, perhaps, to put some hedging strategies in place. On the other hand, if we get a rerun of the late, early 90s and the US does actually move into recession, that takes China with it, so you get a slowdown in Chinese growth from high single-digit, low double-digit growth back down towards 6% or thereabouts. You can see the top left-hand corner gives you that profile for both developed and Asian industrial production. Then you actually have falls in commodity prices in prospect from a top-down perspective by around about late 2008, early 2009, and the trajectory for the currency moves sub 80 cents. So you can see how difficult the currency management in your portfolio is. So having a clear view of what you think structurally should be in place in your portfolio is very important with respect to the currency. And finally, in terms of private equity, with listed markets in a mature stage of the bull market, leveraged buyout activity tends to dry up. M&A activity should orient towards strategic deals financed by equity and high investment grade debt. The leadership in listed markets tends to narrow, and at times there's a lot of confusion and volatility, and I don't think we're out of a period of volatility regardless of whether the US soft lands or not. So that, from my perspective, tells me to keep it simple and look for dividends, good dividend yielding markets and stocks. So I'll leave it there and look forward to your questions. Thank you.
One issue that you might have thought we'd have talked about a bit more by now, actually, is what's going on right now. Is this financial event, should we be treating this as mainly over or under control? And what are the implications of that, I guess? I'm not sure what the implications are, but my suspicion is, first of all, that financial markets for some time will be characterised by continuing high volatility. Peter talked about the terms of trade, and that's something that we perhaps have discussed less than fully, commodity prices. It is, what can you say about them? Well, first of all, I agree with him that the run-up in the terms of trade in the past 4 years or so has been of enormous benefit to the Australian economy. There isn't another developed country in the world that's had that kind of increase in its terms of trade. And relative to where we were, say, about 4 years ago, that increase in our terms of trade is worth about $3,000 for every man, woman and child in Australia. So it has been a tremendous benefit to Australian well-being. Now, you might think, well, yeah, sure, if you've got BHP or you've got Rio, but or if you live in Western Australia, but it turns out that everybody has benefited because essentially the increase in the terms of trade has fueled an extraordinary increase in company profits taxes, which, because no matter what else happens, we're going to run a surplus of about $10 to $15 billion per year, has been recycled in the form of the individual income tax cuts that we've now had for 5 successive years. But what about the immediate future of commodity prices? Well, it's hard, isn't it? You look at any chart of commodity prices shall we say, metals prices or whatever, in a long-run sense, and you'd have to say it's overdone. You can be as bullish as you like about China and India in the long term. To me, commodity prices have to fall, and have to fall significantly at some stage in the near future. Now, I, like many economists, have a box in my office which is filled with, it's labelled things I know are going to happen, but I don't know when. and the fall in commodity prices, I think, goes in that box. What could cause a dramatic fall in commodity prices, because in the past they have been quite dramatic? Well, number one, recession in the US, I guess. Number two, slowdown in China, and it wouldn't take much. If China slowed to, say, 6 or 7% growth for a year, commodity prices would fall. What are the consequences for Australia? Well, on that day I wouldn't want to be holding Perth residential property. And you might think, well, you wouldn't want to be holding BHP or Rio either, but one source of comfort there is the resource sector essentially is trading on still a relatively low PE, even by its own standards. So essentially some kind of commodity price fall is already factored in to the resource sector, which I guess means that the share price has not kept up with that rate of increase of profit. But I guess I go back to the number one risk that's out there, namely the US economy, and so long as that's a risk, I think, then I guess growth assets are not as good a place to be as they used to be, and presumably also there's there are some implications there, I think, also for fixed income. I should stress, incidentally, that the views I gave in the earlier session and the views that I'm giving now are mine alone and don't necessarily reflect what's going on in BT's portfolios.
Peter, what do we do with our resource stocks?
Look, I definitely agree with Chris. I think commodity prices, by any stretch of the imagination, have had a tremendous run over the last couple of years. Most commodity prices, as we sit here today, are sort of anywhere between 3 and 4 standard deviations from their long-term average. Now, certainly there has been major changes in cost structures, which means that the previous cycle averages are going to be somewhat higher this time round, simply because of the cost of supply. And I think that's all fair enough. But at the end of the day, most of these resource companies are generating a return on equity of somewhere between north of 40%, which once again is also unsustainable. Our view, I guess the way we're treating it, is that yes, commodity prices may stay high for another year or so, but at the end of the day, if you look at the amount of investment that's going on right now to debottleneck, to expand production, prices have to come down as that comes on stream at some stage. And it's not hard to see, like, for example, copper. I don't know where it's trading today, but copper's been had a 3 in front of it now for the last 2 years. If you halve the copper price, you still get a copper price that's double last cycle. So you can see quite dramatic, what appears to be dramatic falls, but really in a long-term historical sense, it's pretty much irrelevant. I firmly believe you want to be positioned in the diversified low-cost producers at this stage of the cycle, which have genuine volume growth prospects. I think it's very risky to be exposed to a lot of the, the single commodity type stocks, particularly those that have very high-cost mines, because earnings can disappear overnight with a lot of those sort of stocks. And there's certainly been a lot of IPOs in the last 2 years, which I classify as being very poor quality and very, very, very vulnerable to any fall-off in commodity prices.
Albert Littlesivas. Chris, your comments about the resource dropping off if the United States had a fall goes completely against the statements of BHP Billiton.
I guess we'll have to wait and see. If the US falls into recession, then it's even if the world is somewhat decoupled, then the effects elsewhere will be such that it'll be hard for commodity prices not to fall. But he could be right, I could be wrong.
I just wonder whether we should start thinking about fixed interest in a different category rather than just defensive assets now, given that there's so much credit in portfolios.
I think the big lesson from this cycle is that asset allocators seem to be constrained by the semantics of what asset bucket you're in. So you have fixed income, equities, alternatives. It's just semantics. What you want to understand about your portfolio is where your environmental risks lie. So if you have a recession, if you have a global growth shock, if you have an inflation shock, what suffers? Things that suffer are things that have equity type risk embedded in them. Doesn't mean it's constrained to equities. Certainly the credit markets have equity type risk embedded in them. So if you're after defensiveness in your portfolio, you really want to be holding relatively risk-free assets which don't have those or don't exhibit those characteristics of environmental risk. So a fixed income portfolio for defensive purposes in an asset allocation portfolio has government bonds, treasuries, low risk, maybe inflation-linked bonds and some proportion of cash, direct property that doesn't have any leverage in it, that is only in your portfolio for long-term rental streams might play a defensive role. But as you move out the risk spectrum on fixed income, you start to enter into environmental risk similar to equity. So I think that's a big lesson from this environment.
John Murray, CBAS. Both Alison and Chris have been in violent agreement on the risk of US recession, and you've questioned or posed the question as to whether that'll, what impact the decoupling, as you call it, the decoupling of the China economy and the growth of not just China but BRIC will have in the event that such a recession were to occur. But at what stage within the growth of BRICS and China do you think that there will be a need for financial markets and banking market reform, and do you think that that might hobble any particular growth quite separate from the US recession?
I think that's an excellent question, because at the end of the day, what squares the circle is financial market development in the developing regions. But you can't expect them to be able to do that overnight. This is a long-term sequencing of an industrialisation program. So you start with an export-led growth trajectory, as China is doing in bucket loads and Japan has endeavoured to do as well, just quietly. You do that by keeping your exchange rate under fair value. And as you build the capacity to have domestic infrastructure, and I don't mean infrastructure in terms of buildings and roads and the sorts of things we think about, but social infrastructure. I mean, think about, in a developed world context, think about Europe versus the United States and Australia. I mean, Europe doesn't have as good a social security system, for example, as Australia does, and therefore people are more prone to save than consume, because nobody's going to bail them out when they retire. Excuse me. What you need to see occurring in the developing region is a development of a social security policy, and then a slow development of the financial system, and eventually a floating of the currency. But the fact that that's sequenced is not a bad thing. It's actually quite a good thing. But that is the natural conclusion to what's going on. It also will eventually help square the imbalances that everybody is so concerned about. That you really want to think about the US and the developing world as one area tied by the exchange rate ties. The US spends what Asia saves. As Asian consumption picks up as a share of GDP, and it is still very low, that naturally squares some of those imbalances, and current accounts start to move back into balance globally. But it is a long process.